Ladies and gentlemen, stocks are trading lower today following generally better than expected economic data. This has some big money investors, some guys on Wall Street, saying they are preparing for more volatility. And we will get into that in just a moment, and I will share my views of what's coming next for markets throughout this video. But let me just say, I don't know if this is foreshadowing or if this is a warning, but this headline today from Fed Barkin really had me, crossed, because I have not seen a headline like this in a while. Fed Barkin says a significant market correction could also cause families with more net worth to slow consumption. It's been a while since we've heard about a correction possible in general, let alone from the Fed, and let alone a significant market correction. Now, Fed Barkin goes on to say the biggest risk to growth is probably the unemployment rate. A cycle of layoffs could dampen spending. She says the U.S. is the only advanced economy where GDP is now beyond pre-pandemic trends. She says companies still feel that labor is short on a long-term basis and not firing, though job growth is slowing. She says the current level of unemployment is fine. Whether it is normalizing or weakening is still something to be determined. There is still more demand for housing than supply, and she says the Fed is making great progress but needs to keep it going. I'd say on the day today, there was very much mixed commentary from Fed officials, and I'm expecting the same thing from Fed Powell's speech that is at 3 p.m. Eastern Standard Time today. The big thing you want to be watching for coming out of Powell at 3 p.m. today is if he changes anything from the FOMC press conference that we had last week. And basically, Powell sounded like he wasn't concerned about inflation. Inflation kind of came in line with expectations yesterday, so I wouldn't expect much of a change there. But if he does change anything, that would be an issue. Powell basically said, we don't know what tariff policies are going to be like, so we're not really going to try to get ahead of them as far as Fed policy. He just sounded very much not concerned last week. If Powell takes a little bit more of a concerned approach, a little bit more of that, maybe we're not going to cut in December approach, that is something that the markets would respond to. And if we get any change from Powell, it would probably be, hey, we have some time between now and the December meeting. If the data starts to come in really good, then we may not cut. I think that would be a problem. That is what you really want to be watching out for at 3 p.m. today. Or if Powell confirms a December cut, then that could be, again, another bullish driver for markets. Fed Barkin says the Fed is trying to normalize its balance sheet and not use it to tighten financial conditions. She also says uncertainty is one of the reasons to be gradual and cautious about declaring victory over inflation. And for the first time ever, U.S. money market assets surpassed $7 trillion for the first time, which is really a nod to someone like Tom Lee or some of the bull claims that there's a lot of cash on the sidelines, that we could start to see some of that work its way into markets and drive equities higher. You know, there's a lot of talk in recent days about the markets being at a euphoric level, that we're so euphoric and valuations are so high that stocks must come down. But in the grand scope of things, you got to look at this market in different pieces or segments. If you look at the Mag 7, markets are expensive, or that area of the markets is very expensive. If you look at the S&P on a headline basis, it's very expensive. But if you look at the average stock in the S&P trading at 18 times forward earnings, it's around the historical average. Like, it's not expensive. I think we can start to make the argument that markets are expensive when the average stock is expensive within the markets, and we are not there yet. Now, if we get there, then clearly that's going to be a potential, topping out point for markets, but I just don't think we're there yet. And I think people are starting to get a little more bearish when in fact there's a lot of reasons to be positive, like a Trump presidency and deregulation and potentially, I think, lower inflation, right? These things are definitely positive. And as long as the economy holds up, I don't see much of a bear thesis right now. To be clear, I'm expecting a correction at some point in early 2025. I do think the economy is going to kind of go in waves where things are going to look really good for a period and then start to not look as good and then start to look good again and not look as good again. I think on the downward slope where things start to not look as good in the economy, that's where Wall Street will start to question some of the valuations and get a little more nervous. But until we get, that weakening economic data, I just don't see much of a reason for a correction at this point. Not with the momentum that we are seeing out there. And again, let's just be clear about this. Valuations do not matter in the context of everyday day-to-day trading. People do not wake up one day and go, oh crap, Apple trading at 28 times forward earnings is a little too expensive for my liking. We're going to go ahead and sell that stock. That's not how Wall Street works. They don't sell stocks just because of valuations. Okay, there has to be a catalyst, or there has to be a reason, or something has to happen for markets to say, oh yeah, maybe that valuation's a little too high. Maybe we're pricing in too much good news. Okay, now perhaps tomorrow morning you could get the start of that with retail sales. Retail sales month over month are expected at 0.3%. Let's say if this number comes in negative, yeah, you're going to have concerns about the economy. You're going to have some pretty drastic concerns quickly. Now, I don't know if that's going to happen. I'm not a fortune teller. I'm not a financial advisor. I don't have an inside person at the retail sales, right? Committee that puts that data together. If that were to happen, though, that would be a problem. Now, I'm not expecting it will. I'm expecting we probably get a pretty good retail sales report, probably around 0.5% positive. It's probably going to beat estimates just based on the data recently. That is beat estimates. So, my opinion, that likely causes further upside for markets. Now, tomorrow as well, you get export and import prices and New York Empire State Manufacturing Index. You're expecting things to have gotten a lot better versus last month. You're expecting -5. Last month was -11.9. You also get retail sales excluding gas and autos month over month and industrial production month over month. And some of this data like export prices, import prices, and industrial production, as well as capacity utilization, will feed into a new GDP update, which we are expecting to get tomorrow. You can see here the next GDP Now update is Friday, November 15th, which is tomorrow. And the current estimate is 2.5% GDP for Q4, which the blue chip consensus from the top 10 high side estimates for GDP for this quarter and low side estimates for GDP this quarter in the middle has you at about 1.9% GDP growth. So there could be room for the Atlanta Fed GDP Now estimate to come down a bit. Now, in the very near term, like today, throughout the rest of the day today and tomorrow, it's all going to be about retail sales, but also what Powell says to guide the markets for the December meeting. Keep in mind, the December Fed meeting is December 18th. We will get another CPI report. The CPI report for November will come out around December 11th or so. So we're going to get a CPI report right before December. If Powell pushes back on potentially another cut in December, if he says, if things come in hot between now and December, we may not cut rates. If he says something like that at 3 p.m., then there's a lot of room to unprice that cut. Currently, market odds sit at 78% chance of a cut December 18th. You could see that fall to more like 50-50 and get some downside for markets. Okay, that's the more bearish take on Powell's speech later on today in about the next hour. And I mean, Powell could take this opportunity to kind of push back on cuts in 2025 as well. If Powell does not like or did not like the inflation report that came out yesterday, although it was kind of in line with expectations, and a lot of Wall Street just jumped to the conclusion that yesterday's CPI report allows the Fed or gives room to the Fed to actually cut rates in December. We have not heard from Powell since yesterday's inflation report. So if Powell did not like that and wants to be more cautious, then that's something we will get a hint to today, and that will affect the markets coming tomorrow. Now, with that said, your major indexes are in the red today. The S&P is down 1/3 of 1%, NASDAQ down 0.2 of 1%, the Dow is down 1/3 of 1%, but look at that, the Russell is down 1%, the VIX is down about 1% as well. You are not supposed to see this happen. When the indexes sell off, you're supposed to see the VIX go up. You're supposed to see more fear enter into the markets. That's a healthy market. Well, today, you're actually seeing less fear in the markets than you did yesterday, although the Russell is down 1% today, and the S&P is down 1/3 of 1%. That does not make much sense. So if you are bearish right now, that's one thing that I think makes sense, is the VIX is now not really acting rationally. People are getting a little complacent on the bull side. They're saying things are just going to be great. They're going to be fine in the immediate near-term future, that there's no risk of downside. When Wall Street starts to act like that, that's where things can get a little bit dicey in markets. So although I see the bull case, I think the bull case makes more sense into year end. A big thesis of the bear case right now, just being the devil's advocate here, would be the fact that the VIX continues to fall as some of your Trump trade starts to fade, right? The VIX goes down as there's, less puts being bought. So basically, when the VIX falls, there's less fear. When the VIX goes up, there's more fear. You should see the VIX going up over the past couple of days. That indeed is just not happening. And if there was anywhere to be a little, concerned, a bit of a warning sign, if you will, it could be in the VIX. Now, oil is falling another 1/3 of 1% today. That is great. Gold is down roughly 1/2 of 1%, which I would say is probably a good thing at this point, given how much gold has rallied. TLT is up over 1% today. That is the ETF for the 20-year Treasury. The 10-year Treasury bond yields are down 4.5 basis points today to 4.40%. And honestly, there's not a real good reason why in regards to the data that we got today, because the data actually came in pretty good today. Today, you did get PPI month over month that came in line with expectations on the headline. Core month over month came in a little bit hot at 0.3%. The expectation was 0.2%. But initial jobless claims hit a new 6-month low today at 217,000. The expectation was 225,000. So again, why I'm saying it's kind of strange bond yields are falling is because the data came in relatively good today, right? If the data is coming in good, the economy is doing okay, labor market's doing okay, you would expect less cuts from the Fed. Whereas the markets today are saying, no, we could actually get slightly more cuts from the Fed following today's data, which is kind of mismatched from what we have kind of grown to expect, where weaker economic data means more cuts and stronger economic data means less cuts. Today we got stronger economic data and the market said that means more cuts. Okay, I know it gets a little confusing, but bond yield should actually be green today, not falling 4.5 basis points. That said, CNN's Fear and Greed Index is falling to 64 today. Again, kind of weird when you think about the VIX, which is getting less fearful, and the markets are getting more fearful. This is at 64 today. Yesterday, you were at 67. The percent of stocks trading above their 50-day moving average is at 58.85%. About 2.4% of all stocks are falling below their 50-day moving average today, so not a great day by any means. And the AI Investor Sentiment Survey shows bullish investors at 49.8%, neutral investors at 21.8%, and bearish investors at 28.3%. So you're hitting the highest level of bulls, and this data came out yesterday, since almost a year ago. The highest level over the past year for bulls was 52.9%. So you're getting pretty close to that level. And again, I think that shows the growing level of complacency. And when you get that kind of complacency, then you can start to see some downward surprises. Sentiment for the SPY today over on StockTwits is also falling to 41, which is bearish. Yesterday, you were neutral at 53, so that's not great. Message volume is normal today at 53. Yesterday, it was normal at 54, and participation ratio today is normal at 53. Now, take a listen to this clip on CNBC from PIMCO's Jerome Schneider that says, "We're preparing for more volatility to come."
Last couple of months months?
Well, it's gotten complicated over the past 20 years as we've gone through a whole bevy of funding crisis. It's been the past couple of months, admittedly, central bank policy around the world has become more complicated, divergent, in fact. And what we're really preparing for as investors for not only a higher rate environment, which we've seen over the past couple of years, but really more volatility to come. And there's a lot of question marks. As noted in the previous commentary, the front end of the market is really sort of encountering a bipolar world, one where you basically are reconciling the exact of data with potential policies in the government, which haven't necessarily come to fruition yet. And then the longer end of the market's really contending with a longer term view. Where is growth going to come? What is the impact of government, the G in growth and GDP? And more importantly, where do we think inflation is going to settle in the longer term? And these are things that both the public and the private sector have implications on a go-forward basis.
Why do you think we've seen this constant push on the longer end of the curve? What's your explanation? Because we have a bunch of explanations.
Well, the basic explanation is that you have more supply that's coming in nominal treasuries which need to be issued. And you have an evolving landscape of where that demand to buy those treasuries is going to come from. That isn't necessarily clear in the short term or longer term. So the rhetoric right now is that you'll have a steepening yield curve where the longer end demands more term premium, more compensation for owning those longer maturities. That's to be determined. And quite honestly, where we need to focus on is in the medium term, where we have risk assets that are priced pretty dearly at this point in time. Recognize the fact that the go-forward process, a second derivative as we get into 2025, of the policy implications, and more importantly, once again, inflation and growth, which the Federal Reserve has been focused on, becomes the dominating factor. So December isn't necessarily a big deal because cash rates will continue to go lower. But as we get into 2025, the volatility or the recalibration of risk appetite will be driven based upon where factors of the consumer and the government see inflation in the medium term.
Do you think we're headed into a bear market, a long-term bear market for bonds?
Not necessarily a long-term bear market, but you may not necessarily have the inverted yield curves or the flat yield curves that we've been used to for so long. And the real question is what is the appropriate compensation for inflation? And for an investor, a fixed income investor, as you think about it, you want to be paid on a real basis, on an inflation-adjusted basis, which simply means if inflation simply moves from 2% to perhaps 2.5% over the longer term, there has to be more compensation. And what we're witnessing is a real-time calibration. Investors should take a step back and just survey the landscape for what it is. It's simply a higher rate environment where volatility because of risk asset pricing may come in the medium term. And think about diversification as that simple approach to reduce that volatility. So think in terms of price adjusted terms and what price changes can do over that medium term. And investors will be rewarded on the longer term by looking at lower volatility total returns, which puts you into the income generation category.
Steve?
Hey, Joe, I don't know if you want to play this game, but you know the president probably better than, well, a lot of people, pretty better than anybody in this panel. Do you think at some point, Joe, he can step forward and offer some principles about what he thinks about debts and deficits and tax cuts and offset, and that would calm the market? I don't know at 447 if there's a need for him to do that, but I would imagine the market would react very favorably to some kind of sort of fiscal prudent commentary from the president-elect.
Yeah, no, I don't see that. I think you're going to hear mostly, and it maybe not directly from him, but you're going to hear mostly about how deregulation is going to provide the impetus for a strong economy. I don't think suddenly he's going to say, he's suddenly going to say, that no tax on tips. I don't know about that. I'm not sure about those.
But what if he? I'm just musing here, Joe. What if he said that we're going to have an overall principle here, and our principle will be we're going to not blast the deficit, or we're going to try to be neutral on the deficit. We're going to do all these things.
I don't think I've ever heard him mention the deficit.
Deficit neutral way.
I don't think I've ever heard him mention
the
deficit.
No.
The wild card that I would say is in this whole discussion is growth. And if you have nominal growth increase, then clearly the fiscal side has a recalibration to go. That is to be determined, and what you're seeing in the longer end of the market is not necessarily a question mark, but a natural recalibration in yield terms of trying to assess that risk, if you will. And that makes it more attractive. The Federal Reserve ultimately has a heavy hand if growth diminishes.
Now, it is also interesting today that you are seeing bond yields come down about 4.5 basis points at the time of recording this video. But you do have risk on assets like Tesla down almost 5%. crypto down almost $4,000 from the high it just seen over the last 24 hours. Even though bonds yields are falling a little bit, risk on assets are also falling, which I will say is not a great sign. And I think Wall Street is just preparing for any kind of switch up that Jerome Powell could make. And I will cover that in the next video coming out later tonight, what Jerome Powell says later today. If there's anything that could change the markets, I will let you guys know as soon as possible of that. So with that said, guys, I'm still bullish. I see the bull case as a lot stronger for the bear case. Again, not necessarily for the headline S&P. I'm not talking about the headline S&P when I'm talking about the bull case. I'm really talking about the average stock within the S&P. I think with the backdrop that we have, strong economy, Fed cutting, inflation falling, right, lower regulation, and more favorable business policies from the Trump administration, I think there's a justifiable case that maybe the average stock in the S&P could trade at 20 times forward earnings, which, you know, it's trading at 18 times forward earnings now, which is the historical average. Like, I don't necessarily agree that we have to be range bound to the historical average for the average stock in the S&P. I would say you have historical, unprecedented bullish things going for markets right now, right? This is kind of a perfect setup as long as the economy stays well, inflation keeps falling, and we don't get some crazy tariff policies. So from that perspective, I have to remain bullish on the internals of the markets. The headline S&P, though, not so much, because I think big tech would sell off in a broadening kind of market scenario, and that could keep the S&P not really moving higher, but kind of trading sideways, perhaps even moving lower, depending on how much big tech does sell off. So we also have NVIDIA earnings coming up, in which I think NVIDIA is probably going to be pretty good. I doubt this is the quarter NVIDIA surprises us to the downside. And that's also going to weigh on markets pretty heavy coming next week. So you guys have a fantastic rest of your day. Till the next one, I will see you in the next one.